Ladies and gentlemen, good day and welcome to Rossari Biotech Limited earnings conference call. As a reminder, all participant lines will be in listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star, then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Anup Pujari from CDR India. Thank you, and over to you, sir.
Thank you. Good morning, everyone, and thank you for joining us on Rossari Biotech Limited's Q2 and H1 FY23 earnings conference call. We have with us Mr. Edward Menezes, Promoter and Executive Chairman, Mr. Sunil Chari, Promoter and Managing Director, Mr. Ketan Sablok, Group Chief Financial Officer, and Ms. Manasi Misal, Chief Financial Officer of the company. We will begin the call with opening remarks from the management, following which we'll have the forum open for a question and answer session. Before we start, I would like to point out that some statements made in today's call may be forward-looking in nature, and a disclaimer to this effect has been included in the earnings presentation shared with you earlier. I would now like to invite Mr. Edward Menezes to make his opening remarks.
Thank you, Mr. Anup. Good morning, everyone, and thank you for joining us on our Q2 and H1 FY23 earnings call to discuss the operating and financial performance for the quarter. I hope you all had the opportunity to go through our results presentation, which provides details of our operation and financial performance. We have reported a steady performance in our key business segments during the quarter in a volatile operating environment. And our acquired companies, namely Unitop and Tristar, also have performed consistently well during the quarter. On a consolidated basis, our total revenue stood at 425.4 crores in Q2 and 860.1 crores in H1. In spite of the challenging macroeconomic environment and subdued global demand, we have maintained our margins on a Q-on-Q basis. We are now witnessing some price stability on the raw material front that should help maintain our margins through the second half of the year. As some of you are aware, the company already has a capable R&D setup. With the acquisitions over the past year, we have further enhanced the group's R&D capabilities, and they have been extremely complementary in nature. While we remained within our 4 core chemistries of acrylics, surfactants, enzymes, and silicones, the combined know-how of the R&D teams has successfully developed new green products targeted at our core HPPC, textile, chemicals, and animal health and nutrition segments, new segments of agri, water treatment, etc. This bodes very well for the company's diversification strategy with core chemistries and future growth outlook. Overall, our long-term endeavor is to consolidate our market position as a preferred provider of intelligent and sustainable solutions in the chemical industry. As we look ahead, we foresee an array of growth opportunities across all our business segments. We remain well poised to cater to these growth prospects on the back of our diversified product portfolio, strong innovabilities, increasing customer base, and agile manufacturing establishments. Our teams are now actively seeking out and pursuing numerous business opportunities that should enable us to renew our growth trajectory in the future. With this, I would like to conclude my address, and I now hand it over to Mr. Chari for his comments.
Thank you. Very good morning and warm namaste to everyone. Demand in HPPC, textile specialty chemical segments remains stable on quarter-on-quarter basis. AHN segment registered an uptick on the back of improved volume offtake in the quarter. While the operating environment remained challenging during the quarter, we believe we have navigated the situation well to report steady results. Our customer engagement for eco-friendly replacements for legacy and polluting products remain healthy. Concerted efforts by our R&D team to launch new products have resulted in a robust pipeline of innovative products in our core as well as new segments that we have been nurturing over the past few years. We hope to capitalize on these efforts going forward. During the quarter, we successfully acquired an additional 15% stake in Unitop and 8% in TriStar, taking our holding to 80% and 84% respectively. As Edward G. already pointed out, we have various synergies in the R&D department. In addition, the acquisitions have assisted us to enter new segments like oil and gas and agri and strengthen our presence in the existing high-potential HPPC segment. And in a volatile raw material environment, it has also helped us to have a backward integration to a certain extent. Overall, both have added tremendous value to Rossari, and we are pleased with the acquisitions and the seamless integration executed by our team. The markets continue to be challenging given the global geopolitical situation and the perceptible recession. We are working internally to face these difficult times and are confident of maintaining our margins throughout the year. With a strong balance sheet, robust R&D capabilities, adequate manufacturing capability, and a diversified product portfolio, we are well poised to capitalize on the upcoming opportunities in the Indian specialty chemical industry. On that note, I would now request Ketan ji to share his perspectives.
Thank you, Mr. Chari, and to everyone. This quarter, we reported, as Mr. Chari said, a steady performance across all our business lines. On the profitability front, after a sharp volatility in raw material, we are now seeing some kind of price stability coming into the market. This has helped us maintain our margin profile. Gross margins during the first half have improved by 357 bips, and margins were stable at about 13.3%, in line with the last year. Currently, we are witnessing signs of stabilization of key input prices as well as on the supply chain front. However, it is still very difficult for us even now to take long-term calls given the macroeconomic situation and the political situation globally. We still feel that there is more pain for some more time now, and organizations like Rossari, which have very strong fundamentals and financials, are much better placed to withstand these challenges. We continue to believe that in a normalized operating environment, along with many of our cost optimization initiatives, we should be able to improve overall margins going ahead. Our objective still continues to be to get back to our EBITDA margins of 14 to 15%. Our acquisitions are integrating well as growing in their businesses. Their effective integration is helping us successfully during this challenging year. Also, our strong working capital management has also supported performance during the quarter. Overall, the company's operating and position remains healthy, and given a normalization on the overall macroeconomic front and on the RM situation, we expect to deliver consistent performance across all our business verticals going forward. I think that's more or less from I will now ask Mansi to take you through the financials for the quarter and half year.
Ketan sir. Good morning everyone. Let me provide you with a brief overview of the financial performance for the quarter ended September 30, 2022. On a consolidated basis, revenues came in at rupees 225.4 crores as against 434.7 crores in Q1 FY23. On a consolidated basis, revenues from operations stood at 240.9 crores compared to rupees 233.7 crores in Q1 FY23. On a standalone basis. Revenues from HPPC stood at 303.9 crores, contributing to 71% of revenue, followed by textile business at 91.4 crores, contributing 22%, PHN at 30.2 crores, contributing 7% to total revenues. On the profitability front, EBITDA stood at 56.6 crores as against 57.7 crores in Q1 FY23. PAT during the quarter stood at 23.9 crores as against 28.7 crores in Q1 FY23. Depreciation was higher at 15 crores owing to amortization of fair valuation on account of consolidation of subsidiaries. Interest cost during the quarter was higher at 8.2 crores, partly due to increase in borrowing and partly due to Ind AS accounting of purchase price allocation options. This is an optional charge which will be accounted for till 100% of the shares of the subsidiaries are acquired. As mentioned earlier, we have acquired an additional 15% and 8% stake in Unitop and TriStar, respectively, quarter. This acquisition happened through internal accruals and liquidation of investments in our books. On that note, I come to the end of my opening remarks and would request the moderator to open the forum for any questions you may have. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Nitin Tiwari from Yes Securities. Please go ahead.
Hi, sir. Good morning. Thanks for the opportunity. So my first question is related to our HPPC segment. So we've seen a revenue drop on a sequential basis. So is this related to price, or is this largely a combination of price and volume? If you can throw some light on that. And related to that point only. So on the standalone basis, our revenues have more or less been steady. So does that mean that our subsidiaries have faltered somewhere in terms of revenue contribution? So that would be my first question. Yes.
Yeah, Tiwari ji, good morning. On volume basis, we have grown on a consolidated basis in HPPC2 also, but the price have fallen. The raw material prices have fallen, so consequently FG prices have fallen. But I think we have nearly 7-8% growth on volumes in HPPC on a consolidated basis.
So basically the drop is mostly price linked. So sir, the correlate to that point, so on a standalone basis, our revenues are sort of steady, but so does that mean that Unitop and TriStar have not contributed as much to revenue as in the previous quarter? Is that the right read?
No. Mr. Tiwari, if you see for the subsidiary, last quarter was for Unitop, it was a key season for agro. So hence, we had even indicated this in the last quarter that the sales for the agro products of Unitop have been higher in quarter 1. We've seen some stabilization in that in quarter 2, and that is what has impacted the slightly lower sales quarter on quarter on a consolidated basis. But overall, if you see, the drop is just about 1% or 2% on the top line on a consolidated basis.
So, sir, can we have that number of revenue from TriStar and Unitop for the previous and for this quarter as well?
We do not disclose that on a quarterly basis. On the annualized accounts, then we'll show you all the numbers.
Right. And so, secondly, on the in the previous call, we had discussed number of new product opportunities which are being evaluated, which will be basically a combination of the capabilities that we have across our entities. So, any update on that? How where we stand in terms of product development and time to market, etc. You can throw some light on that.
So, Tiwari ji, this is Edward here. As you well know, the macroeconomic situation led to demand shrinking in the international market, and supply chain side has improved after COVID, and all other issues have reduced. Now, this led to a rapid correction in raw material prices, and customers put on hold many purchases except critical raw materials. Now, Rossari saw this coming, and hence what we did is we had, as a proactive means, approved a lot of surfactants that Unitop manufactured in the market, which they were not selling to Rossari earlier. So that is a very proactive way in which we capitalized on the synergy between Unitop and Rossari. So a substantial amount of surfactants that Rossari, which was not purchasing from Unitop, we started purchasing from Unitop. Apart from that, using the Rossari marketing strength and distribution strength, a large number of new products were introduced to the customers of Rossari. So that is another big cross-selling opportunity that we utilized to pick up sales in this quarter. Then there were a few products that were being developed for regenerated cellulose basically, and a joint development between Unitop and Rossari led to the first orders for these additives in the regenerated cellulose market manufacturing. Similarly, spin finishes, where a large component are the EOs and the EOPOs that are manufactured by Unitop. These spin finishes for primary as well as secondary finishes were introduced successfully in the last quarter in polyester POY, FDY, as well as in polypropylene as well. We also did a lot of work on the novel coating polymers for technical textiles. And these also were successfully trialed in the last quarter, and we have got the first bulk orders for these products as well. So if you look at the synergy, I have a big list of products that we've already done, already introduced in the market because of the synergy between the three companies that we had acquired in the last year. So all in all, we are well on track to take the best and to make the best of the opportunities of the synergy between these companies.
Sure, sir. That's very helpful, sir. Thanks for the detailed answer. So, as Chariji mentioned, that in this quarter we had roughly a growth of about 7-8% on the volume front. So, would it be fair to assume that the second half would be much stronger in terms of at least the volume growth as compared to the first half, and then the revenue trajectory would also be strong? Would that be a fair assessment?
See, Mr. Tiwari, as all of us talked about in our opening remarks, given the overall situation globally, we are seeing a lot of headwinds in the global market. The West is looking at a perceptible recession coming in. So for us to give a guidance on exactly how the second half is going to be is a little bit of challenge as of now. We would be happy if the second half we are able to replicate what we've done in H1 with a slight growth of 5 to 10%. I think that's what we are looking at. It's as I said, there's a pain which is there, but we'll have to see how best we can navigate during this time. As Edward sir said, we have a lot of new products and new opportunities which we hope will help us through these times. But it's a little difficult currently to give a very strong guidance on how. But our effort on the margin front will be to maintain these or even improve these margins going forward. So better to sell high margin products. I think that's what the key is for the organization now, and that's how we are looking at it, at least for the second half.
Great, so thanks a lot. I'll get back in the queue.
Thank you. A reminder to the participants, anyone who wishes to ask a question may press star and 1 at this time. The next question is from the line of Ankur Periwal from Axis Capital. Please go ahead.
Yeah, hi sir. Thanks for the opportunity. First question on the standalone business. So we have been seeing slightly lackluster results there for quite some quarters now. Your sense in terms of which are the weak links and how are we trying to address that?
Ankurji, namaste. This is Chari here. I think on the standalone basis we have done quite well. Compared even to the last quarter we have grown. So the unwinding of raw material prices, the falling of FG prices, in terms of volumes also we have grown in spite of the macroeconomic conditions which are there. Of course, the supply chain volatility has decreased substantially, but the price volatility is there. So the inventory, if you bring it at 100 rupees, when you by the time it reaches here, the raw material prices have changed. So these all things taking into consideration, we still have done quite well in all the three segments. The textile business, as you know, the exports have suffered for all the textile customers. But we still have been able to nearly retain both on the volume front. The per kilo prices have come down a little. Cotton prices have been very, very volatile. It went up to more than 1 lakh a candy. Now it has come down to 60,000-70,000. So spinning mills are not producing yarn, and so yarn is not coming for fabric production and processing. Exports markets have been slow. The European markets have been very slow in the last 2-3 months. But I think our teams have done quite well in terms of performance. If you see the volume has grown, gross margins have grown. I think looking at all this, I think it is a good performance.
Sure, sir. Chariji, my question was more sort of on a Y-on-Y basis. I take your point in terms of gross margin improving even on a Y-on-Y basis. But just one clarification. You earlier mentioned 7 to 8% sort of a volume growth. Is that a Q-on-Q growth or a year-on-year growth?
Q-on-Q growth, because the year-on-year was not comparable. The second quarter of the last year was the pipeline was empty. If you remember my comments and calls during the earnings calls. First quarter of last year we had huge COVID and we had a lot of issues with even supply chain, and second quarter we had a lot of raw materials, and we did not take advantage of the situation and supplied to our customers at acquisition contract price, higher volumes, and big customers we supplied. You could refer to my earnings calls that time, and we have been able, we took advantage of this pipeline which was empty and pumped in and were able to produce. So it was an abnormal quarter which we had always, even in the second quarter of the last year earnings call, we had said that it was an abnormal call. But if you see quarter on quarter, even the standalone, we have been able to grow in spite of the finished goods pricing coming down. We have been able to grow even Rossari on a standalone basis. The margins have grown also in EBITDA margins also have grown.
Sure, sir. And how will be the volumetric growth, let's say, in both the subsidiaries, TriStar and Unitop? Not Q-on-Q, because you mentioned the agri business being slightly heavy there, but let's say on a Y-on-Y basis.
Y-on-Y basis, now if you see our subsidiaries last year were not really part of our...
Correct, which is where I was checking that number. So you will have those financials with you.
Yeah, but I can still give you an heads up. I think we've seen a significant growth in both Unitop and TriStar on a H1 to H1 basis. So if we see the H1 now and the H1 performance of both the subsidiaries prior to our acquisitions, I think we've had almost overall on the top line almost a 40-45% growth in both of them.
Ketan bhai, on the volume terms, how this will play out?
See, as I said, I do not have the exact volumetric numbers of both these companies for the last H1, but I'm sure the growth will be a mix of both volume and pricing, because the 40-45% growth will have a mix of a substantial increase in volumes. We are seeing that quite evidently, with Rossari coming into the picture. I think we are actually witnessing a huge growth in both these companies through our efforts and the whole synergy exercise that we've carried out.
Ankurji, to add to Ketan sir, comments, all the acquisitions have done exceedingly well. We have been able to integrate very well. We have had no surprises in all the acquisitions. Unitop, of course, is outstanding. The amount of growth which has happened, both on profitability and also, on volume and value growth. So we are very, very happy that it has been 1 year since we acquired. Many, in the markets were, worried. Even, we were not sure. We are doing, 2 acquisitions and which are substantial size, and we have been able to turn around, integrate very, very well.
Sure, sir. Where I was coming from was, even if I probably take the seasonality part into the numbers for Q1, we were roughly around 160, 170 crores revenue on a quarterly basis. This quarter we are 180, 185. So trying to see if the the distribution led sort of synergies between the 3 companies Is that benefit already there in Q2 numbers, or probably there could be further upside here, which could drive, the growth for the company?
Yeah. So I think you're right. If you see the H1 numbers, a lot of these synergy numbers have come in the consolidated numbers that we've reported.
Sure. Okay. And secondly, on the margins front, while, again, comparing H2 last year and now, broadly, the margins are intact for Unitop and TriStar, put together. On the standalone basis, while we are seeing year-on-year improvement on the gross margins, obviously, we are still lower than what we were, let's say, in FY21. Trying to understand, is this a new normal here because of maybe, absolute RM price pass-through, and hence the percentage terms, numbers are coming down? Or should one expect these numbers to go to 30-35% range, over a period of time?
So, Ankur, currently, I think we should go with these numbers, at least for the next few quarters.
No, sorry, Ketan bhai. My question was more on a 2 to 3 year perspective. I understand, near-term volatility and hence probably, limited, expansion there. But let's say from a 2-3 year perspective, should this 26-27% gross margin go to a 30-35, or should we remain at these numbers?
No. So given a longer perspective, I think a 2 to 3 year horizon, we will definitely go back to the 30-35% kind of margins on a consolidated basis. There are a lot of initiatives that we have already started undertaking. I think these are a little more long term. Some of them Edward spoke about some time back. But I think on a longer term basis, we will definitely go back to our 30-35% kind of gross margins.
Sure, sir. And last, if I may, on the working capital side, while on a year-on-year basis, we have maintained it pretty well. But if I go back, we used to be 45-50 days working capital. Even in the first half, we are seeing a dip in payables as well as receivable days. So what should be a steady state number one could factor there?
So I think on a consolidated basis, between 70 to 75 days should be an ideal working capital cycle for us.
Okay.
While we had, as you rightly said, a few years back, we were at about 45-50 kind of days. But I think currently the way the business is growing and the way some of the subsidiary cycles work, we are targeting internally around between 70 to 75 days kind of a working capital cycle. So that's what you can consider.
Sure. Okay. That's helpful, sir. That's it from my side. Thank you and all the best.
Thank you.
Thank you. The next question is from the line of Sumit from IDFC. Please go ahead.
Yeah. Hi, sir. Good morning. I have a question on the balance sheet side, sir. The interest expense seems to have gone up this quarter. So Ketan bhai, if you can just explain a little bit here, and what should be the outlook, let's say next balance sheet date, which is March. Is this extra borrowing because of the...
Interest expense has gone up marginally because we have taken debts in Rossari Biotech, but majorly it is because of the Ind AS accounting of our purchase price, accounting of our subsidiaries. So that impact is higher. I mean, out of total interest expense of 8 crore in the quarter, around 65 to 70% is because of the Ind AS accounting entries. So that Ind AS accounting entries will be there for next 1 year till the time 100% acquisition is done.
Okay.
It is basically a notional entry. It is not a cash flow.
Okay. And just on the raw material side, I think you touched on the initial comments, but can you please explain, let's say, to what extent, Chariji mentioned that raw material prices have stabilized, but to what extent it has stabilized? I mean, are you able to take a longer term inventory call because the stability now is in place, or you are still avoiding, taking a slightly longer term inventory on the books? So just some more insights on that.
Yeah, Sumitji, I'm Chari here. The supply chain has stabilized, but the prices have not stabilized yet. there is still huge volatility in the prices. There is also where we see prices going up and down because of demand supply gap, and because also if there is something which is imported by traders, the traders are not taking position. So long term we cannot take any positions. And if you see our inventory levels compared to the last quarter, it has gone down from 120 crores to 111 crores. So we have been very conscious on not taking any long positions in any raw material in the past quarter, and we will be conservative in any inventory positions for this quarter as well.
Okay. And sir, some guidance on the margin. I think initially you said you should be able to reach 14-15%. Is that what I heard correctly, or if you can just please repeat on that? On the EBITDA margin.
On the margin front, what we had said was over a longer period of time, we aim to get back to our 15-odd% kind of margins. But in the immediate future, for the next few quarters, I think as I said, it's still becoming difficult for us to give you an exact guidance, but we should be able to maintain the margins we are seeing in the first half.
Okay. And just one more question on the acquisition, which is Unitop and TriStar. So some developments that you can share as to, let's say, any new customers, new geographies, new products in the Europe, or Europe plus one strategy. If Rossari has been able to make inroads into some of those early negotiations or early contacts. Some qualitative inputs on these two acquisitions, please.
Sumitji, Unitop, is focused on the agro business. They are leaders in agro surfactants, and they are doing quite well in their spheres. The production facilities are very good, and market demand is very good. We are trying to focus on exports for the agro business, but also the domestic businesses we are trying to grow. Unitop has been a very, very good acquisition for us in terms of EBITDA and what we paid for it, and having no surprise, no governance issues. So we are very pleased. After 1 year of acquisition, both companies seem to have grown 60-70% on year-to-year basis in terms of top line. Volume growth also has happened. We do not have exact figures because there was no comparative figures for last year. But we think we have grown both in terms of volume and value. TriStar also, if you see the last quarter, it has grown well. But TriStar major exports are Europe, and Europe is affected. So we see some subdued demand from Europe for TriStar. The TriStar main is into personal care additives, and personal care additives in the Europe market is slow. We had a major, so we see some slowdown in the European market. The US, as both the subsidiaries had big proportion of exports, and we see some slowdown in US also, besides the big slowdown in Europe. We are not able to give you a guidance on what happens, but in terms of being happy, we are extremely happy with Unitop and both TriStar. They have done very, very well in terms of what we expected and what they have done. We are very happy. The teams at both the companies, we have been able to integrate well. The finance, and the procurement, we have been able to integrate well. Cross-selling synergies, we are still focusing, working, taking trials. And Edward G just mentioned now that SAP is something which we are implementing in Rossari. So SAP, I would request Ketan sir to give a feedback on SAP.
So as our process of integration, there are a lot of steps which we took post the acquisition of these two companies. And on the digital front and the IT front, the first step we took was to integrate the softwares across all the entities. And that's when we decided to get into SAP. Now SAP is in the process of implementation across all the companies in the group. So I think going forward, with this the ERP coming on to stream with SAP HANA, I think the veracity of information, data, as well as some of the decisions in terms of our products, their margins, and our strategy, I think we'll have much more better data, as well as we'll be able to take much more informed decisions on our strategy going forward. So SAP is one of the activities that we've undertaken across the group.
Sure. And so among the smaller segments, let's say, textiles or animal health, and the annual report mentioned about, setting up a new line of for polyester chemistry at Dahej. So some update on that. And secondly, on the animal health side, I know it's a small business right now, but can you talk a bit about slightly longer term developments here that you're doing? I think this was about 200 products with some 40 distributors. So how are those brands doing, and just some update over there from a longer term perspective.
So Sumitji, as we had mentioned in our previous call, that there were 2-3 lines of businesses that we were pursuing, and basically also using the synergy between the acquired companies. So one of them was sizing. There is sizing in the textile industry, both for polyester as well as cotton. Now this has taken off nicely. So we have already established the polyester resin sizing for water jet looms already, and this business has taken off. Apart from that, we have recently introduced a few acrylic-based sizes for polyester, and one of the large polyester manufacturers has approved our product, and the first orders have gone out. So in the sizing, we are very happy with what is happening. Apart from sizing, like the acquisition of Romac, the new technology of silicone polymers also was acquired, and as you know, in finishing of textiles as well as in agro, a lot of silicone polymers are being used. So we have been able to very successfully substitute or very successfully replace imported items of silicone polymers which were used in textile finishing. So the newer technology, which we call as the block silicone, silicones have been now indigenized and manufactured both at Romac, as well as we have expanded the facility at Dahej. So Dahej has a bigger facility now set up to manufacture these silicone polymers. There is a breakthrough also in the silicone polymer for agro. So in agro, a lot of silicone polymers are used for spreading or super spreading and wetting, and we've successfully made the first batches for the silicone polymers and got them approved at a few large users, and we are sure that this will culminate into business in the next year. We've also applied our R&D for coating in technical textiles. So in technical textiles also we have got approvals for these coating chemicals, as well as we have expanded our footprint in water treatment chemicals. Earlier we had not used the opportunity to use our synergy between the textile chemicals as well as the water treatment chemicals. But now what we've done is the textile chemicals has taken over part of the sales of the water treatment chemicals, and we've been able to successfully crack some huge textiles central effluent treatment plants and introduced a range of coagulants there. Apart from that, we are also, like the last time I said, some special polymers for pharma coating, which have already been developed, and we are happy to inform that approvals for the manufacturing of these coatings at Dahej have been received, and shortly we will commence manufacture of these pharma coatings. We are also focusing on green surfactants, and one of the surfactants that we are focusing are on the glycolipids, and R&D work has started in this area, and these products, these green surfactants will now help us to get into certain personal care ingredients, and help us in the formulations for animal health as well as home care, especially laundry detergents and shampoos in our pet care. We are also in the process of reintroducing the grinding aids and dispersants both in the ceramic and the cement industry. In the animal health and front, we have recently commissioned a granulation facility to introduce a range of new products for animal health, as well as we are in the planning to put in resources for premix, that is the vitamin premix in animal health, which is a very large portion of our business. So all in all, most of our initiatives that we have taken in R&D have either been successfully deployed in the last quarter or are on the verge of deployment in the bulk.
Sure, sir. This is very helpful. Thanks a lot, sir. I'll come back in the queue. Thank you.
Thank you.
Thank you. A reminder to the participants, anyone who wishes to ask a question may press star and 1. The next question is from the line of Nitin Tiwari from Yes Securities. Please go ahead.
Thanks for the opportunity again, sir. My question is related to the synergy that you highlighted with respect to Unitop and TriStar. So, if you can just elaborate a little bit in terms of whether that synergy has been in terms of utilization of the plant or in terms of supply chain. So, how have we, we've been able to grow the revenue by about 50-60% that you indicated on a YOY basis? So, what has basically led to that sort of a growth? So if you can just help us understand that a little bit.
So the cross-selling, as Ketan sir said, we have been able to implement in the last few quarters in our subsidiaries. We had connections with a lot of our customers who were using surfactants, and so we helped our subsidiaries to grow business in those customers, and that is the reason. The more business came into subsidiaries than Rossari because we wanted the business to happen directly, but we have now positioned Rossari as a non-agro single point company for the future, and we are slowly building up sales from Rossari for all the subsidiary products also. The in-house consumption also we've been able to give to the subsidiaries, and so we are buying a lot of raw materials which we are buying from outside from our subsidiaries now. In terms of also a joint working between the three subsidiaries, the teams and our good R&D teams and our consultants and the production teams at the three facilities have combined and worked as one team in 4 projects, and these 4 projects could do well in the future. As Edward sir said regarding silicone surfactants, so we had 3 teams from Romac, from TriStar, from Rossari, and also from Unitop working together for the phenoxypropanol. Again, our marketing teams, Rossari marketing teams, and the TriStar manufacturing and the Unitop manufacturing team worked in one synergy. Similarly, on more silicone surfactants, the Romac and the TriStar and Unitop teams are working well. What we also got in the subsidiaries was excellent production base in terms of machinery, with very, very good quality of machinery, but also good amount of skilled manpower. And this we were able to use and help them catalyze the growth. If you see Unitop and TriStar, their average growth was 10-20% in the past few years, but we have been able to grow well just because we were able to get into all the customers, and the goodwill of Rossari and our connections to the customers helped the subsidiaries grow.
So basically, we can basically sum it up that some amount of production was shifted from Rossari to Unitop and TriStar, because you mentioned that as far as Rossari is concerned, you are trying to develop it as a non-agro entity. So did the utilization levels at Unitop and TriStar increase materially between last year and now?
Yes, definitely. The volume growth, as Ketan sir said, we have had volume growth at both the subsidiaries compared to the last year.
Great, sir. So this is very helpful, sir. And secondly, sir, if you can just help us understand the utilization levels currently that we have in our facilities across, across Rossari, Unitop, and TriStar, and then I'll just add another question. So basically, on the interest cost front, you just indicated that because of Ind AS treatment, the interest costs have gone up. So if you can just elaborate that point a little bit as well, like that how that effect has come into place.
So on the capacity utilization, I think we were at similar levels like the first quarter, so about 50-55% across all our entities. And your second was on the interest cost. So interest cost was basically, these acquisitions that we had done. So there is a liability which we have created in the books for the balance amount of money which we have to pay for the balance acquisition percentage. And for that liability, it's discounted as per Ind AS, and a discounting charge in terms of interest is booked in the P&L. So that's the interest charge which is coming in. Also, along with that interest charge, we also do a value on the amount that we paid for the acquisitions. We do a PPA allocation based on which it is an amortization that happens, which again is a P&L charge, which again comes under the head of depreciation. So if you see current year and last year, you will see a significant charge both in the depreciation front as well as on the interest charge. This interest charge will happen till the time we do the complete 100% acquisition of both the companies, and the liability in terms of the balance shareholding gets discharged.
No, sir. Thank you, sir. That's very helpful.
Thank you. The next question is from the line of Siddharth Purohit from InvestQ Investment. Please go ahead.
Hello. Hello, sir. Sir, in the last couple of months, we had taken some price hike, but now that probably the macro industry is not in favor of most of the large players. So are you facing some issues, or maybe are you seeing some sort of price rollback, or is that a concern going ahead? Because certainly a lot of other industries are not in a position to go for price hike. That is one thing. And secondly, how has the key raw material prices behaved during the beginning of this quarter?
So, Siddharth ji, namaste. I'm Chari here. If you see, our EBITDA, 114 crores of EBITDA in the first half. This has been our highest ever EBITDA ever in the history of Rossari on consolidated basis. But ये केतन सर और मानसी जी का सब ये डेप्रिसिएशन का नोशनल और इंटरेस्ट का नोशनल डाल के मेरा कैश फ्लो तो है, बट ये लोग मेरा पैट में सब गड़बड़ कर डालते हैं. So we have done very well in terms of getting higher amounts of margin from the customers. So what we believe is we have been brave. We have been able to pass on price hikes to the customers. So, but what happens is now the price per kilo of a finished product is falling because the raw material prices are falling. So we are confident on the amount of margin, but the selling value may look lesser. But we are focused that we will continue to grow or maintain the existing EBITDA margins. Looking at the macroeconomic situation, we don't see any pressure on margins that way, because we have understood now and we have stood by our customers. As we said in the past calls, when the price increased substantially, we did not increase the amount of margin, but we maintained our margins. And so that is why we are seeing gradually improvement in margins across Rossari. In terms of business, of course, as you said, the Europe business looks weaker for TriStar this quarter, but Unitop and Rossari, the business seems to be stable in spite of all these headwinds.
Okay, sir. Okay, thank you.
Thank you. The next question is from the line of Rohit Nagaraj from Centrum Broking. Please go ahead.
Yeah, thanks for the opportunity. Sir, last quarter we had indicated that for FY23, our guidance for EBITDA would be 250 crores. We have already done about 114 crores and a PAT of about 150 crores, and we will relook at the numbers Q2. So do we still maintain the same guidance, or we want to probably revise it based on Q2 or 1H numbers? Thank you.
Yeah, so Rohit, you're right. We said that we'll come back on these numbers post our Q2. Now, given the way the business is shaping up, and as during the call we've discussed about globally how the markets are shaping up and the demand profile. I think on the margin front, as we have already indicated, we expect to end the year on similar kind of margin percentage. On the top line, we should be closer to that 2,000 crore number which we had indicated. So we should be between 1,800 to 2,000 crores. So that's what we are foreseeing now. H1 we've already done about 850, 860 crores. So if we simply double that, we'll be closer to that 1,800. But these are the estimates as of now, and our aim will of course definitely be to surpass these numbers. But currently, the way we see it, on the margin front, we should be in similar kind of margin range of between 12 to 14%, and on the top line we should be between 1,800, 1,900 kind of run rate for this year at least.
Right. Got it. So second question is in terms of the exports opportunity. So after TriStar and Unitop acquisitions, are there any positives which Rossari standalone has witnessed? Because I mean, we have seen that cross-selling has been happening across our companies. But anything particularly on the export front, and there the opportunity could be sizable over the next, say, 2-3 years? Thank you.
So for TriStar, we see phenoxypropanol. Okay, now it will be Rossari by the time this the propanol. This is a good coordination and cross synergies between three companies, Rossari, Unitop, and TriStar, and this we could see could be a good volume growth for us in the future. Agro surfactants and surfactants as a category, we think there could be substantially uptick. If the export markets improve, we could see substantially uptick in this. Silicones for agro application could be something also see a very good market in the future. So we continue to focus on our core chemistries of enzymes, silicone, acrylics, and surfactants, and continue to see how we can make our customers more competitive, either in terms of value, or in terms of sustainability, in terms of green chemistry, reducing the loads of BOD, COD, TDS. We see a very, very good future, definitely.
Right, sir. Got it. Thanks a lot, and best of luck, sir.
Thank you, Rohit. Thank you.
Thank you. A reminder to the participants, anyone who wishes to ask a question may press star and 1 at this time. As there are no further questions, I now hand the conference over to the management for closing comments. Over to you.
Thank you, everyone. I am sure we have been able to answer all your questions satisfactorily. Should you need any further clarifications or would like to know more about the company, please feel free to contact our team or CDR India. Thank you once again for taking the time to join us on this call. Bye-bye. Have a good day.
Thank you. On behalf of Rossari Biotech Limited, that concludes this conference. We thank you all for joining us, and you may now disconnect your lines.